It depends what the bond market is going to be worried about. Sometimes the bond market is worried about inflation. Sometimes the bond market is worried about the sovereign credit risk of the United States. But if we find ourselves in a situation where the Supreme Court nullifies the tariffs by saying that the president, for example, overreached his authority, or that this wasn't really a definable emergency under the IEEPA, and they strike down the tariffs, and that injunction is immediate, well, what's going to happen? All of a sudden, the U.S. conceivably could lose up to $3 trillion or $3.5 trillion
earnings run of $23 billion
of tariff revenue over the next 10 years.
I'll do the math.
What's the bond market going to think then? We've already passed the One Big Beautiful Budget Act. It increased the deficit by about $3.5 to $4 trillion over the baseline over the next 10 years.
Right.
So we're stuck with it. That's law. And now all of a sudden we don't get the revenue from the tariffs.
Paul, I just did the math. I'm a HP12C.
Wow, look at
keeping
that.
up with Wizman and Macquarie. 23 billion times 12 is $276 billion.
That's a lot.
It's a run rate that the Yale Budget Lab has right now.
There you go.
Is that okay?
Yeah, that's how we get effectively to about $3.5 trillion over 10 years. Absolutely.
And after subtraction and addition, I went down in flames. Paul, continue.
So what does the bond market think about these deficits? I mean, in my lifetime, it hasn't cared.
Yeah, it hasn't, because the presumption here is that something will eventually be done about it. And when you think about sustainability of debt and deficits, and you are trying to get from a situation where it's unstable to stable, there is a limited number of ways you can get there. You can raise taxes, you can reduce spending, you can monetize the deficit, you can do some sort of financial repression whereby you keep interest rates so low at the front end, shift government borrowing to the front end, and then lighten the burden of the interest burden on the government. There's a limited number of ways, but those are about it. You can, of course, deregulate and try to grow the economy out of its debt deficit problem. That's a fifth way. Okay, but these are limited ways, and I think that because Congress could always step in here and at least try to cut spending or try to raise taxes in an emergency situation, the market has felt that it's never going to get to that point.
Yep.
I think, however, that the market is starting to realize that in view of the president's One Big Beautiful Budget Act and the fact that it locks in these deficits for effectively 10 years, there's a lot more worry these days than there was, let's say a month or two ago about deficits and debt.
Well, I think maybe we see that perhaps with the U.S. dollar, which, again, is still down 8.5% off that early year peak. That doesn't feel... I'm not sure, when I look at that decline in the dollar, I'm not sure if that's just selling off from an overbought position and now maybe here's a more normalized level, or if it's telling us something else here.
Yeah, I think it is telling us something else. And you're right to say that it's a sell-off from overbought levels. We've been saying that as well, right? You've had a real appreciation of the dollar for about a dozen years so far, and it's about time that we got some relief from that. But at the same time, let's face this, objectively speaking, there has been a big increase in policy uncertainty in the U.S.
Yep.
It is linked to the executive orders. We have seen more executive orders under this administration than we have since the Roosevelt administration in the Depression period. I think that is lifting policy uncertainty, and investors, foreign investors especially, like to think of the United States as a place with ordered liberty. They don't like to think of it as a place with managed chaos. We've been shifting from ordered liberty to managed chaos, and I think that in and of itself requires a discount on the value of the dollar.